Welcome back to No B.S Mortgage Advice. My name's Brad East, and today we're going to be talking about different loan types and different loan features. So we'll get straight into it. The first, two that you would have heard a lot of in the market is fixed versus variable. Now, fixed is you're locking in an interest rate and a repayment for a set amount of time. So that might be you're locking in your interest rate, let's say we'll use 6% as an example, for 2 years. That rate and repayment is going to be locked in for 2 years at 6%. If you were to exit that loan for whatever reason early, you would get charged a fee, especially if the rates went down. So benefits of fixed is, you've got the consistency in repayments and rates over a set period. When rates were quite low during COVID, around that 1.9%, I think some of my clients were getting, it was a great idea at that time to lock in for that 2 or 3 or even 5 year period. Right now we're at the peak of a interest rate cycle, so probably not the best idea to be locking in at the top of an interest rate cycle, but again, that's up to your personal preference. Now, on the flip side of that, we have variable rates. That goes up and down depending on what the RBA decides each month, and I think in 2024 they're actually going to be meeting every 6 weeks, so not every month. So if the RBA decides to put their rates up, we'll put the central bank rates up, the lenders usually follow that. Now, a variable rate will go up, a fixed rate won't. So obviously you've got a little bit more flexibility there. You can make a lot more extra repayments than you would if you had a fixed rate. Most fixed rates cap you at around $10,000 per fixed rate year or whatever it is. So you are a little bit restricted in your extra repayments. Now, the other benefits of a variable, if you exited any time during that period, there's generally next to no early termination fees. You might pay a discharge fee or something like that. So it's a lot more flexible to come and go from that lender if you're on a variable rate. Now, again, given we're on in my opinion, the top end of that rate cycle, we will start to see rates decrease in 2024. So a variable rate might be the way to go there. Now, the other two things you might see is principal and interest repayments and interest-only repayments. Principal and interest means that you're paying down the actual amount that you've borrowed. So let's say you borrowed $500,000 as an example. The $500,000 itself is the principal portion, and the rest is interest. So interest is calculated daily and charged monthly. Now, when you're paying off principal and interest, you're paying down both. So the $500,000 over a 30-year period and a 30 years, it'll be zero, and you would have paid a fair amount of interest in that period. Now, with interest only, that $500,000, the principal portion, does not go down. So that over a 30-year period, if you did for whatever reason have it on interest only for that period, would still be $500,000. Now, the benefit of the two, obviously, the principal and interest one's a no-brainer. You want to pay off your loans, but interest only is used a lot by investors, so property investors, to keep their overall out-of-pocket expenses down, and the interest portion in an investment loan is tax deductible. The principal portion is not. Now, the other thing that we get asked a lot of as mortgage brokers is the difference between an offset account and a redraw. Now, the big difference is an offset account is a separate account that is linked to your home loan. So it's a separate account, got its own account number, and it sits in your internet banking or wherever it is. Now, we'll use $100,000 as an example. If you had a home loan of, let's say, $500,000 and you had $100,000 in cash, you could place that into an offset account and it sits in its own account, hasn't gone into the loan, and it's sitting there. Now, that $100,000 will subtract what you pay interest on. So you're actually paying interest on $400,000 instead of the total $500,000 because you've got that $100,000 in offset. Now, opposite to that, you have what's called a redraw, which isn't a separate account. You're actually paying it into the home loan account. Now, that $100,000 would go into the home loan and it would be sitting there as available funds. So when you looked at your internet banking, it would say balance might say $400,000 instead of it being $500,000, available funds $100,000. And you can just pull that out whenever you want it. So not a huge difference in the way that it calculates interest. They both have a very similar benefit. The benefit of an offset is it's in a separate account and you can see it. And some lenders actually allow you to have multiple offset accounts. Some lenders allow you to have up to 8 or 9. So you could have a savings account, a salary account, and sort of list out those different accounts and they all offset your home loan. With the redraw, it's just one account. So all the funds go into one account and they sit there. Big benefit, I guess, of just the redraw is there's usually a lot less fees involved with what's called a basic home loan. So with a package home loan that has the offset, usually comes with a credit card and it's got all the bells and whistles. There's usually about a $400 fee per annum, and the rate is pretty similar to a basic home loan, which is just a redraw, but there's no annual fee of $400. So again, it really comes down to personal preference. You would definitely need either of those, whether it's the redraw or the offset. And I think 99.9% of lenders do offer one or the other. And it just comes down to personal preference on what you would prefer. So that, in a nutshell, really rounds up what types of loans we have and types of repayments and features. Thanks for joining us.